Hello, everyone. Glad to see a lot of familiar, well, not faces, but familiar names. So today I'll be talking about payment optional mortgages, which is a new term that is starting to come out. A lot of the reverse mortgage companies are starting to say, "Hey, it's a payment optional mortgage," and I'll get into why they're starting to use that terminology. But I do want to talk a little bit about some of the different strategies and options, not just for reverse mortgages, but other products that are like reverse mortgages that effectively set it up so that you don't have to make a payment on your mortgage, which is really, really useful. So thank you for coming to the webinar tonight. I'm going to go over a number of different things. First, I'll talk about the basics, typical uses, creative uses, a little bit more on the math and what you could expect. And then we'll get into some myths and facts, different options to finance, and what your home equity looks like over time, and then some examples, and open it up for some Q&A. So let's get into it. What is a reverse mortgage? Because this is the most common payment optional mortgage that is available. A reverse mortgage is a loan that's secured against the value of your home. And these types of products specifically are usually designed for Canadians that are age 55 or older or better. One thing to note is that there are some lenders that are what are called private lenders that will also do payment optional mortgages that are regardless of the age, and they just look at the equity in the home, but the rates are higher. So you can still do payment optional mortgages with private lenders, but usually the loan amount that they give you is a low percentage of the overall value of the property. And you still have to renew those mortgages and negotiate on them. Whereas a reverse mortgage, you just set it up once, and then you never have to deal with that mortgage again. So there's a bit of a different product there. A reverse mortgage specifically would be providing up to 55% of the home value. Generally, the younger that you are, the less money they're willing to give to you, and the older you are, the more money they're willing to give to you. And an important feature of this is that money is tax-free. So there's no government impact to government pensions. There's no impact to your taxes in any way. Whenever you refinance or whenever you get a reverse mortgage, for instance, all of this money is tax-free, which is an important part of the financial planning strategy. And I'll talk a little bit about some of the financial planning strategies that people have been looking at with reverse mortgages in a couple of slides. Probably the most important key is that no monthly mortgage payments are required. You can still opt to make payments if you want to. You can make them as frequently as you want. You can make regular payments. You can make payments here and there, and work on paying down the loan so that less interest accrues. But a payment is not required. So this is why they call it a payment optional mortgage. And you maintain ownership and control of the home. So even though there's a mortgage on title, it's just the same as a regular bank mortgage going on the title. And you will never owe more than the home value. So this is something that's important. A lot of people are concerned about, well, what happens if the value of the property decreases and the loan amount that I have increases? In Canada, at least, the private or the lenders that offer these reverse mortgages, they are in a position where they will ensure that even if the loan amount increases past the home value, they will eat that difference. And so they will never ask for you to put money into your home. I know that in the 80s, and this is where, to a certain extent, some reverse mortgages got a bad rap. In the 80s in the US, there were some companies that would lend out to people, provide reverse mortgages. They're relatively predatory and high rates, etc. And if people were upside down, then they'd actually go after the estate and do all these other things. In Canada, we're much more conservative, and that's why they don't go above 55% of the value of the home. It ensures that, for the most part, there's a very, very low likelihood that the lender will ever go upside down. And I've seen some of their books on this. Less than 1% of their mortgages are actually underwater. So the lenders are very comfortable with it, and they're the ones that take on that risk instead of you, the borrower, taking on that risk. So if you have a couple of typical uses for reverse mortgages, for the most part, a lot of people are looking at this to provide additional cash flow by paying off debts, or even providing a monthly draw. So in addition to just getting a lump sum on the mortgage, you can also decide either to take a lump sum and a monthly draw, or even just to get a monthly draw each month. And so you can set that up, and there are calculators that we have access to that would allow you to figure out how much money you could take on a monthly draw and for how long. But there are programs and products available where you can have a lump sum pay off your existing mortgage, and then even get another monthly draw that you can receive monthly as an income, which is really, really cool. One of the typical uses is just helping people stay in their existing homes. There's a certain point where people say, my income's dropping and I can't really afford the mortgage anymore, or I can't afford these other debts that have accumulated. Maybe there's some health issues. Maybe there's some challenges where you might need to do some upgrades to the home to be able to keep living in it, and other things like that. And so the typical use here is, helping people stay in their existing home. And then it's also a very unique product where it provides an alternative method for qualifying for a mortgage, because for the most part, the income is not a factor. The lender still wants to see that you have enough income to service any other debts that you have, but generally the reverse mortgage is paying off your mortgage, which is your biggest debt. And we usually try to wrap up any other unsecured debts that you may have, and clearing all of those off, and then having no payment on it. So usually, just your simple pension income is enough to service your property taxes and strata fees if you have strata. So it's providing an alternative option to provide financing for individuals in this case, because for the most part with the banks, equity lending doesn't really exist. But in this case, it's an equity loan. They're not really looking at what your income is versus the debt load. They're really looking mostly at what is the value of the home, how old are you, and how much are you looking to borrow. So it is technically an equity loan, which is very difficult to get with lenders or banks. So there's a couple of creative uses that I've seen and have employed myself with some of my clients, and I've observed as well in the industry. One of the cool ones that I've seen is some people are using this to invest in real estate or other investments. And so some people will get a reverse mortgage on the home, and then use that to buy a rental property. And then there's no payments on the reverse mortgage, but now they're earning cash flow from the investment. So that could be an investment such as buying a rental property. That could be investing into what's called a MIC, a mortgage investment corporation, which usually returns investors about 8% year over year in cash flow, which is a way of generating some extra cash flow for yourself. You also, if you bought a rental property, you'd have appreciation on the rental property. And here's one of the cool things. And of course, I recommend that you talk to an accountant to verify this information and make sure it applies to you too. But interest is still accruing on that mortgage. You're not paying a payment on it, but the interest still accrues. And if you've borrowed the money to invest, then the interest portion of the payments is usually tax deductible. So what's happening is you're collecting an income, and you're still able to write off the interest cost that is accumulating that you're not paying, and still be able to deduct that on your tax returns. So it's a nice way of not creating a large tax liability for yourself, even though you're creating an income, because you get to write off the interest portion, even though you're not paying it, which is really cool. Another one that I found quite useful is for early inheritance. So one of the challenges is, real estate is very difficult to qualify for. It's very expensive today. And I find that, kids and grandkids, they're having some difficulties getting into their first home, or maybe their second home. And, parents want to help their kids, but they can't afford to borrow money against their home to then give to the kids. And the kids might not have enough free cash flow to be able to service those payments on the parents' home either. So one of the solutions is instead of, waiting for years and years, and then eventually that family home goes into the estate, and then eventually that money passes down to the children. This is an early inheritance type of strategy where a reverse mortgage may be a good solution, where you're getting access to the home equity tax-free and then giving it to the kids. And yes, now the equity in that home, whether it's your home or your parents' or grandparents' home, will slowly erode. But at the same time, building equity in the kids or grandkids' home. And so it does offset that way, because at least now they're getting their life started, starting to build things up and getting their own home. And so it just helps with the timing of things. People are living longer nowadays. People are living into their 90s, and if your parents own a home that's worth $2 million, and you're waiting until they're in their mid 90s and you're in your 60s, you probably don't need the money at that point. But if you're in your 30s or your 40s, it may help you if you had a bit of a leg up and perhaps had an early inheritance. It's a way of kind of getting their life started. So very interesting concept here. We've been seeing a lot of this happen where parents or grandparents are wanting to help their kids get into real estate and get their life started, but they can't afford the payments to borrow money against the home, and they don't have other assets that they can provide. The other way that we've noticed is equity lending. So equity lending, for the most part, has disappeared with pretty much all the banks. And because they're only looking at age and property in the loan amount that you're seeking for the underwriting, it's something that for the most part only private lenders offer, except it's much cheaper than private lending options. So ultimately, a reverse mortgage is a really useful tool for being able to qualify for a mortgage that you wouldn't otherwise qualify for. So it's kind of cool. There's a few myths, of course, that are attached to the reverse mortgage. There's a negative stigma out there. One of them is that the bank owns their home, and it's not that the bank owns the home. And I guess you could say that if any mortgage is registered against their home, that lender has a financial charge against the home. And some people like to say colloquially that they own the home, but technically they don't. You're still the owner of the property, and they're just registering a mortgage on the title. Also, for these Canadian lenders, all of them say we will never put you in a position where you will owe more than the home value. Whenever it sells, if you owe more than the home value, then they will write off the difference, and you will not be faced or put into a position where you have to put more money into the estate in order to sell a property. They're not a lender of last resort. They're becoming a more common lender as a really good solution. And I have a couple of examples that I'll provide in a couple of slides. But they're not a lender of last resort for the most part. They're now becoming a little bit more top of mind when you start to think about it and look at different options, some with payments and some that have a payment optional feature. And another myth is that the bank can force to sell, and that's just not true. The lender cannot force you to sell the property. There's nothing in their clauses that can force you to sell it. So you're still in the driver's seat and still in control. I do want to go through a couple of examples and also how the interest would accumulate. And it's important to remember that interest compounds either direction. If you are investing into something, then the compounding effect works in your favor. If you are borrowing money, especially in a reverse mortgage, then the compounding interest works against you. So you can see here that in the reverse mortgage scenario, if you started off at $25,000, the loan amount would slowly increase over time. And so the amount of interest that accrues slowly will increase. And over time, your year-end balance would be increasing. Now, the interesting thing that I want to point out here is on the far right side is the estimated remaining home equity. So in general, if you assume a certain amount of appreciation, this model is using a 4% appreciation. I know that I often like to use about 3% appreciation, by the way, but I think that the numbers would be very, very similar, or at least be pretty close here. But if you're assuming about a 3 or 4% appreciation, and again, in this example, they're using 4%, you can see that the home value goes from 1.2 million and it continues to increase over time. And so the estimated remaining home equity is actually going up over time because the appreciation of the home is accumulating faster than the interest is. Now, in this case, of course, it's a very small reverse mortgage that's being borrowed here in this example. And if you did a larger reverse mortgage, then you probably see that in some cases the home equity may erode. But in most of the pro formas or expectations of the future, remember, the lender doesn't want to be in a position where they're upside down. So they will usually project and ensure that although the equity in the home might slowly decrease, it's extremely unlikely that it'll ever be upside down. And so it's unlikely that you'd be in a position where you owe more than the home value. So this is just painting a picture for you on the illustration. And anybody that does want us to put together this and get you some more information, either for you or for a family member or something like that, we do have the ability to create some charts and graphs that actually show you in different circumstances what the interest cost is, what the mortgage balance is, and what the home equity looks like. And you can see what that charts out to be over time. There's also a couple of other products that we've been using too. So there's a lender that we like to use, and we call it the pre-reverse lender. And I'll give you an example of why I'm suggesting that. They will offer a mortgage and I should say, and or a line of credit. And they do not require you to make a payment every single month on the mortgage as long as you have an available limit on your credit. So what I mean by that is an example is at the moment I'm getting a client of ours who wants to retire. He has about a 270 mortgage approximately, and then a little bit of debt that he wants to roll into it. So we're getting about a $290,000 mortgage, and then we're getting a line of credit behind that, and the line of credit limit will be about $460,000. Now we ran some numbers, and it looks like the client would not need to make a payment for about 10 years on that. And so every single month, the mortgage payment can go onto the line of credit, and the line of credit will continue to increase, and it will increase like the reverse mortgage, it'll increase exponentially. But it would take a little over 10 years before that line of credit has been maxed out, and then payments would be required. And at that point in time, a lot of people would then say, well, maybe it's time to go into an actual reverse mortgage at that moment. So the reason that we like this pre-reverse mortgage is usually the interest rates are lower. So the reason that I have a bit of a range here with the interest rates is that it depends on how you qualify. This lender does have a net worth program that opens up and allows clients to borrow and qualify for a larger loan, which is good. But the interest rate is a little bit higher for that type of product. But you can qualify based on your net worth underneath this program, and you don't have to make any payments until you've reached the limit. So we can reverse engineer how long you could not have to make a payment on this type of product. And of course, it's cheaper than a typical reverse mortgage. Right now, a reverse mortgage interest rate is somewhere in the mid sixes. This lender, if it's a standard mortgage with income that you're using to qualify, then the rates are in the low fours. And if it's a product where you're having to use net worth, then it's a rate that's in the high fours for a fixed rate term. And then as of right now, the rate would be between 4.95 and 5.2 for the line of credit component. So pretty competitive rates, and that's why we call it a pre-reverse, because if you can qualify, you can sneak in there. Often that's a little bit better than going right into a reverse mortgage, but it's a way of still getting the feature of not having to make a payment every month, which is the primary benefit a lot of people are looking for. Another key that is a really cool example here. I had a client that came up for renewal on both a residence and a rental, and we're looking at the numbers. And I remember looking at it and saying, well, the numbers are a little bit tight. So I called and we went through everything, and I asked the question, like, how are you guys finding your payments per month? Or is it tight? And they said, it is a little tight. And we couldn't actually qualify them to do a refinance with an A lender, like a bank, because of the debt load that they had and because they are now entering into retirement and income was starting to decrease. So what we proposed and just gave them a different option. We said, well, here's one option that we could do that would help get the payments down a little bit. And here's option two, which is to put a reverse mortgage on the residence, which then collapsed and got rid of that entire payment. And then by getting that entire payment eliminated, it now opened up more borrowing power for us to refinance the rental property and be able to increase that enough that we could pay off all of their debts, re-amortize it over 30 years. And the difference in payments was significant. There's a few $1,000s per month that we were able to save them. And their interest cost was marginally higher by doing this, but with a much better payment. And it would allow them to have a much better lifestyle. So it's a really cool idea and way of structuring things, because when there is no payment, the lender doesn't have to use that for debt servicing. So sometimes we'll use a reverse mortgage in a scenario like this to be able to eliminate a payment, and then that allows us to then requalify the borrower for a different mortgage that we otherwise wouldn't be able to qualify them for. And then the third one here, this one was interesting. So I had a client that was coming up for renewal, and he had a large line of credit, and then also a second mortgage on the property that he got a couple of years ago. And the payments on that were over $10,000 a month. Now, when we were looking at things, the numbers weren't quite working, and the only option I could really come up with was a B lender at a higher interest rate and fees and everything. And actually, what ended up happening is the example in the middle option here. After I came up with that idea, I thought, oh, this could apply to this client as well. And so we ended up being able to do a reverse mortgage on the home. Now, interestingly, we are still a little short on money. So we couldn't quite get enough of a reverse mortgage on the home to pay off the line of credit and the second mortgage. But because we are lowering the payments to zero on that mortgage, we're able to go to a different property and refinance that and increase the mortgage enough to pay off and cover off everything. So we basically had a little less money on the residence, a little bit more money in another property, but it balanced out. And then it was allowing us to get rid of that entire payment on the residence, and that was saving over 10 grand a month. And we were able to get a little bit of extra cash out as well. So it's a really great solution, especially when the rates and everything that we're looking at were B lender rates, which are about the same as what the reverse mortgage lender options were anyways, but a way better feature on the actual monthly payments and putting the clients in a much better spot. So pros and cons. There's lots of pros and cons to each. And the pros, of course, are there's no payments. Allows you to stay in the home if you're living in the home. Allows you to qualify based on your equity. And then, of course, there's all of these different strategies that can be really useful. In some cases, we've worked with financial planners who are starting to realize that this might be a really good option for their customers that are looking for a way of increasing their assets and increasing their income into retirement. And so we're starting to use that a lot more for this circumstances. But we also have to talk about the cons too, because it's not a perfect product for everybody. The interest rate is higher than a regular mortgage. It's in the mid sixes instead of the low fours like a standard mortgage. And so in some cases, if you can afford the payments, it may still make sense to do a standard mortgage. Also, the penalties are typically higher than a standard mortgage, especially in the first few years. Eventually, usually with most of them at year 4 or 5, it's about the same as a standard mortgage. But if you're breaking it in the first 1 or 2 years or sometimes 3 years, then the penalties may be more expensive. And then also on top of that, it's max 55% financing, and that's typically for those that are a fair bit older as well. So you're usually going to get less money on these types of products than you would on a standard mortgage, assuming that you can qualify. On the flip side, if your income is low and the home value is very high, you might find you actually qualify for more money in a reverse mortgage than you do in a standard mortgage. So it kind of depends on your circumstances. One of the things that we can do is we can help to give you an idea of what your qualifications are, like how much you would be able to qualify for this type of product if you wanted to learn more. You can email us at info@greenmortgageteam.ca to see what your qualifications are. Also, we have a really cool event coming up soon. And so this event is on November 20th, and we're going over a lot of different things at this event. So we're doing some discussion about payment optional mortgages and also some other lifestyle solutions. And so we're going to have a couple of different speakers. And if this event is a success, which I think it will be, we'll probably end up doing another one next year and get a slightly different types of speakers out to the event. But this is coming out on November 20th, and it's going from 6 o'clock until 9 o'clock. Some of the speakers that we have coming out to this event would be Eva DeGaro, who works for Home Instead, and she helps with restructuring and redesigning homes to make it easier to live in your home and basically extend your ability to stay in your own home. We also have Adrienne Nagy coming out, and she's going to be talking about neat elite organizing, which is really cool. But one of the things that I've noticed with a lot of our clients that are helping their parents or grandparents with that move is they're actually noticing that it's a lot of work to go through the decluttering part of either moving or selling, etc. And so this is an interesting thing, and I think that having her as a speaker to come out is actually a really useful, not financial thing to discuss. We have Victor Chang coming out, who's a good friend of mine, and he works at Home Equity Bank, and he helps educate people about the benefits of reverse mortgages. So he'll go into a little bit more detail than I did today. And then we have Richard Letting and Evan Drigas, who are both lawyers for Letting & Co. And they'll be talking a little bit more about estate planning, which is also, of course, dry but very important. And it's something that that they're going to talk about things. Rick loves to tell stories, so I'm sure he's going to have a number of stories to share with you guys and keep you entertained. But if that's something that you're interested in, then it would be really good for you guys to register. I know that we are running low on space. I think we only have 100 slots in the room, and I think we're at around 80 or so. So we're starting to get up to the upper limits now. I will post the event registration in the chat here if anybody wanted to come up to that. If anybody has any questions, here's our contact information. Feel free to reach out to us. We're happy to go over this in more depth and explain it. There's lots of things to know about. I do have a information sheet that goes into a little bit more detail, but the differences with the different reverse mortgage lenders, because there are a few of them out there, and the pros and cons. And of course, we can talk about different options too. The other payment optional product, that pre-reverse mortgage option, which is an interesting way of doing it. I've been doing a lot of those lately. But there's a lot of different things to think about and consider when looking at this. So thanks for coming to the webinar. I will open it up for some questions now. As usually, there's a few people that have questions about things. So if you do have a question, feel free to put it into the Q&A, or you can also put it in the chat if you'd like to too. You guys are taking it easy on me today. No questions? Okay, if there's no questions, then I'll wrap things up for here. And if you do want to attend the event, please go ahead and register. You'll probably see an email from our team coming out again in the next week or so, just to make sure that if anybody that wanted to make it can make it. And other than that, it was great to see you guys come out. Thanks so much. If anybody has any follow-up questions or wants to dive into anything, please reach out. Happy to chat. Thanks so much, everyone. Have a good night. Bye now. Oh, there's just one question that popped in here. Is there a limit on the equity in the home to qualify? No, it's just that you can't finance more than 55% of the home value. So that's something you do have to look at. And then if you have a HELOC, can you still get a reverse mortgage? Yes, it's just that the reverse mortgage would have to pay off the line of credit. So the reverse mortgage would clear off the line of credit completely. There can't be another financial charge on the title. The reverse mortgage would be eliminating that. Okay, another question. If you're 55 and your wife is 53, can you apply? So both parties have to be at least 55. Assuming that she is on the title. If she's not on the title and it's just you, then you might be able to do it. But generally speaking, all of the title holders have to be 55 plus. Here's another question on the pre-reverse or reverse. Can you put the rental properties in the program or only the primary home? So usually they want the residents to be part of it, but they can sometimes stretch that loan over the residents and on top also over rental property. That's one of the ways that you can expand and get a little bit more financing by stretching the loan over both the home and the rental property, but they always want the home to be a part of it in those cases. The pre-reverse option, there are ways that you can actually do that just on a rental property specifically. So it doesn't need to. It's just harder to qualify for that product, but it is possible to do that on a rental property as well, on its own. Awesome, good questions. Okay, I don't see any other questions. And of course, if anything else comes up, please just reach out. Happy to share any other thoughts or ideas. And I know for some of you, this might be getting the creative juices thinking and going a little bit. This is not usually a instant, oh yes, I'm going to definitely do this and take this. It usually takes some time to kind of think about it, absorb it, and talk to different people and make sure it makes sense and from a financial planning perspective, et cetera. And you, Patrick, yes, so the question is, you have to have an income to qualify. You have to have a little bit of income just to cover off your property taxes and your other expenses, but it can be quite minimal. And some lenders are more flexible than others with related to that. But they usually want to see a little bit of income in order to cover off the expenses. I haven't done one yet in this way because I've always had clients that had some income, because most clients have at least a Canada pension or old age security, which is usually enough to service the property taxes. Um, but if you're in a position where that's not enough, then there might be an option where you might be able to get a reverse mortgage where it's giving you cash flow every month. And maybe that's a way where you can say, well, I don't have enough personal income, but I'm getting a reverse mortgage where I'm going to be getting the cash flow, which is going to be enough to service the payments. So that might be an option. I've never done that before, but I presume that that might be a way to work that out. Okay, awesome, guys. Well, thanks so much for coming out and attending today. I look forward to seeing hopefully many of you on November 20th, and have a great finish up to the year. Thanks so much, everyone. Bye now.